everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Paul Sachs, who is the Chief Investment Officer of Aurum Option Strategies. We're here on the floor of the CME in New York. Paul, thanks very much for coming back on the show.
Thanks for having me again.
Now, I want to ask you something. We've all heard of the magazine cover indicators, sort of this indication of market sentiment. Has it gotten too bullish, too bearish? With respect to gold, I saw an interesting headline last week on a very popular financial blog which said gold looks like death. Now, language is very important to me. Whenever I see language like that, like death, collapse, calamity, these sort of very emotional words, it says to me, at least in the short term, maybe things are a little bit overdone on the downside. I want to get your take on that perspective.
Yeah, that's a very fair point. Sentiment now for gold is excessively bearish. I mean, bordering on emotionally bearish. I mean, there's a chorus. And there are fundamental reasons that back up that case, but it seems to me that it may be priced in. We just came off $100 in about 5 weeks. I agree with you. I think if one wants to get long on a trading perspective, you could use that sentiment as a contrarian indicator, as a reasonable entry point.
First, let's talk about the fundamental reasons behind the bearish move, the down move. I guess you're alluding to the dollar's strength. Is that part of the reason?
Absolutely. The dollar strength is driving the lower prices across multiple asset classes like crude and others, really having a strong effect in gold. Primarily, the dollar is rallying as our QE is coming to an end. It seems Europe is about to pick up. You've seen weakness in the euro, and the yen is doing terribly as well. So the dollar, for all intents and purposes, has become the safe haven destination. So stronger dollar, lower gold.
Yeah, it almost seems more like a currency crash than some dollar bull market. But don't you think that gold has held up pretty well, despite we see some of you mentioned the yen, multi-year lows against the dollar, euro, multi-year lows against the dollar, and gold still seems to be holding up relatively well, wouldn't you say?
Yeah, I would. The numbers, if you take a deep dive into the math, you can make an argument for gold at $800 an ounce or lower, and I think that's what some of these people are writing about in the media and other news outlets, and so that's why the sentiment, that's contributing to the very, very bearish sentiment.
Yeah, I think Goldman had a prediction of about 1,000, and I know a very widely followed technical analyst, this guy Ned Davis, last week came out with a 660 call, so that's even below the old 1980 peak of 800. So longer term, actually, let's get back to the point that it's kind of holding in right here now. I think some display of resilience.
Yeah, well, the level we hit last night actually is the same level that it bounced off of twice last year during the very violent washouts where there was paper gold liquidation in the West and physical buying in the East. So last night's low of around 1183, very, very close to last year's lows of 1179 and 1181. So you can make an argument that this is a reasonable place to get in, with a stop, of course, if you're looking to trade this on sort of a retracement or rebound type perspective. Shorter time frame, a week, 2 weeks, 3 weeks, so on and so forth. There's been some really interesting order flow in the gold options pit. About 10 to 15,000 calls were purchased last week.
Really?
In a very specific area, 1 year, red Dees, 1,600, 1,800, 2,000 call. So, there are people who are willing to go against the grain here.
Wow, that is interesting. Let's talk about, the flip argument. Let's get back to the bearish argument. Do you think gold has been a disappointment to a lot of people in the sense that, we had all this QE, all this supposed money printing. We've got new wars going on. We have this ISIS now and Ebola and all kinds of geopolitical or topical things and we're not seeing it react.
Yeah, certainly the gold bulls, they're pretty disappointed. I mean, we've had a host of things like you've mentioned. In the past few years, we've had even more direct confiscation of fiat currency. I mean, think Cyprus, Syria, shutdown of U.S. government. And we've had every reason, every textbook safe haven reason for gold to really rally. And that's in addition to your your primary thesis of broad expansion of the monetary base, which in theory should be very, very bullish for gold. So it's been a tough road to hoe for gold bulls, but you have to just really take a look of what's happening. The equity markets continue to perform well, and that's where the money goes.
Now, when we look at the sort of the global perspective, and when we look at traditional players in the gold market, buyers, you're talking about India, you're talking about China. How has that had an impact, in your opinion?
It is the most important factor, I believe, currently in the gold market. Eventually, if you are a long-term gold bull and you think at some point, at some unpredictable time in the future, there will be a revaluation scenario, it will be after China has accumulated a lot of gold. So right now, what are they doing? They're buying, but they're being very deliberate, very patient, very price sensitive. They buy it on dips. But they're the number one producers and number one consumers of gold. So in the long term, you have to pay very close attention to that phenomena. Above and beyond that, there needs to be a catalyst. There needs to be a real sell-off in the U.S. dollar. It needs to go not from 79 to 86, but from 79 to 83.
How about the talk of, obviously we don't see it manifesting in the market right now, but there's talk of the dollar eventually losing its reserve status. Do you think that could be potentially the catalyst?
Yeah, I mean that's the gold bulls' end game, right? That's what they really think. They believe that the Chinese want RMB to be on the same level as the euro and the dollar on the international financial stage. They don't necessarily desire to be the world's reserve currency. It's kind of like you'd rather have a friend that owns a boat instead of own a boat. I mean, there's a lot of work that comes along with it. But certainly they're looking for central banks around the world to want to accumulate RMB just in the way that they accumulate USD, and gold is going to play an important part of that formula.
Now, you are an options trader, and I know last time you were here, you gave some really interesting longer-term option strategies for anyone who might be inclined to want to have a bullish position in gold and use a derivative like an option. Can you go over that again?
Yeah, sure. I mean, I'm the biggest gold bull in the room, but given that, I'd like to also say I own zero gold, zero physical gold, and no GLD, no ETF holdings. And it's exactly for the reason that we've sort of alluded to in the past. It's a very difficult market to trade on the short term. But if you want to maintain long-term exposure to the upside, always keep your chip on the table and never be stopped out, then you can sort of expose yourself to call spreads, in the options market. You can ratio them, make them premium neutral so that when nothing happens, you don't sort of bleed to death as these options expire. And in that way, one day when you wake up, should gold be hundreds of dollars higher, you'll know you're going to participate.
So how do you employ that strategy? You're buying a near-term call option and you're selling an out-of-the-money call option, and then the difference is whatever premium, sometimes very little?
Yeah, that's correct. So what we do is we take advantage of the fact that there's different prices associated with different options of different tenor or different calendar expirations. So we might have a 1x2 call spread on with 12 months to go. That is going to enable you to take premium in, but of course one must be long net calls in total, so we can buy a couple shorter term calls, 30-day calls. Those are going to be a lot cheaper, but a lot, and they're going to expire, so you're going to need to buy more when those do.
It's like an insurance policy.
That's exactly what it is from my perspective. You want to have a little bit of exposure to gold by way of it being an insurance policy for your portfolio, and not have it be what you want in terms of a source of absolute return, trading in and out, trying to catch the levels.
Great strategy. Paul, thanks so much.
Thanks for having me.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.